Okay, happy 2024, everybody. I hope that everybody had a nice holiday season and we're back in the swing of things. We're starting this new video series where I'm going to give a quarterly market update. Our goal is to provide some meaningful content for our clients going forward and get in the habit of doing this regularly. So, hope you enjoy this. So, my name is Scott Hayes, and I'm the president and CEO of ISC Group. And I'm going to give a little bit of a review of what happened in 2023 in the markets and talk about what we're thinking in terms of growth and opportunities for 2024. Well, 2023 turned out to be a great year. It didn't necessarily feel like it. I'm going to show something on that here momentarily, but the S&P 500 ended the year up more than 26%. Bonds were also up quite a bit at 5.53. All of that return came in the fourth quarter, where the aggregate index was up 6.82% on the quarter. So it really was a strong year. As you may have heard, though, most of the performance in the market was driven by the return of a very few companies called really the Magnificent Seven, the Googles, Facebook, the Meta, wherever they're calling themselves these days, Apple, NVIDIA. Those names represented the lion's share of the return in the market. And as a result, they've come quite pricey compared to overall stocks. So you can see here in the upper left-hand corner, the top 10 stocks, they made up 86% of the return of the S&P 500, and their valuations reflect that. They're trading at about 138 times their relative average, where the other 490 stocks that make up the S&P 500 are only at 88%. So while some parts of the market are really pricey right now, not everything is. We see here in the upper right-hand column where the top 10 stocks now make up over 32% of the S&P 500 weighting. So we think actively managed opportunities are good for 2024 and beyond, and we'll see. There's been a lot of talk this year on the wealth management side. We've done a lot of work in fixed income. CD rates now are at levels we haven't seen in a number of years. It's been nice to be able to get income without risk. Same with treasuries and so forth. But what this shows is that in prior periods of peak CD rates, they peaked in 84, 85, at much higher levels than today, over 10%. And today we'll see, they appear to have peaked out around the 5% range. But 12 months forward from when CD rates, the 6-month CD rate peaked, historically stocks and bonds have tended to outperform CDs over the subsequent 12 months. And even a 60-40 portfolio of 60 stocks and 40 bonds significantly outperformed CDs over the following 12 months from peak rates. So, while CDs are great and for your fixed income opportunities, it can be great. You still should keep a diversified approach in our minds. Speaking of 60-40, there was a lot of talk in the past year or two that the old model is dead. A balanced portfolio of 60% stocks and 40% equities. But we see here that in 2023, just a 60% S&P 500, 40% aggregate bonds would have made 18%, and it in fact is not dead. It did very well in 2023. What this chart shows is that even though most years have been positive for stocks, and in fact 33 of the last 44 years returns were positive in the market, every year these dots below are the maximum drawdown that occurred within the year. So it's not uncommon at all that we see a 10% or more decline in the value of stocks at some point during the year, and that shouldn't concern you if it happens in 2024. It's a normal part of the market cycle. I mentioned earlier that consumer sentiment is still pretty low. It bottomed out here, back when inflation hit 9% at the end of 2023, but for 2022, it's been climbing a little bit since. It's still lower than sentiment has been 86% of the time over the last 40 years. So while we're off the bottoms in sentiment, that tends to be a pretty good time to invest compared to when it feels better to invest. So peak sentiment, when everything feels the best, everybody's happy. Historically, on the 9 sentiment peaks over the last periods of time, the S&P has only gone up about 3.5%, where from the troughs, when it felt the worst to be investing, markets have averaged 24.1% over the following 12 months. Now, bring that up because this year's an election, obviously, a presidential election year, and we always advise that you not over-invest based on political ideals, because the fact is, looking back at history, we feel consumer confidence is better when your guy's in office, whether you're Republican or Democrat. And the reality is, in terms of both the economy and the market, uh, between a Republican majority, a Democrat majority, and divided government, the economy has done well on average over time through each type of administration. And on the S&P 500, how do stocks perform? Well, Republicans have been in control 11% of the time, average 12.9%. Fully on the Democratic side, 9.9% average, still almost double digits, 29% of the time. And divided government, where we have, either the House and Senate are Republican, or the executive branches is, and the other is Democrat. When a divided government, it still averaged about 8% during those administrations. So it should not overly emphasize this election, probably in terms of what's going to happen with your investments. And now inflation, that's been the big story of 2023. And we see here that it did peak back in the fall at over 9%. Got really hot for a while. Of course, the Federal Reserve tried to fix that by raising the discount rate from basically 0 to now 5.25 to 5.5%. And it seems to have worked. We're now in restrictive territory. Inflation has come down. Doesn't necessarily feel like it because the cost of things don't come down when that happens necessarily. It's just the rate of change of them increasing has slowed down significantly. To that extent, there's a lot of talk now about whether the Federal Reserve is going to start cutting that discount rate, right? Because they can raise it so high, and at some point it'll start to choke off the economy. It could lead to a recession. So they're trying to engineer what they're calling a soft landing, where we get inflation under control without causing a major recession. So the Fed, they actually put out their own estimate of what they're going to do this year, and they've anticipated about 75 basis points worth of cuts in 2024. Now, the market is expecting more than that. They're pricing in something like 6 cuts. We'll see. We think that they meet again in January. They could cut then. I think it's more likely they wait till the March meeting, but we'll see. But that could be a surprise for the market if they cut faster or slower than what's being anticipated currently. Now, we're still at this position where we have an inverted yield curve, which is not normal. The normal cycle's shown on this chart at the bottom, where you're paid more to hold longer-term debt than you are short-term debt. And that makes sense, right? Because you have more uncertainty over longer periods of time than you do the short end. But right now, because the short end of the curve is so high with the Fed hiking the discount rate, you're still at 5.25 to 5.5% on that. You're paid more right now to own short-term debt than you are long-term debt. And that's what's known as an inverted yield curve. And historically speaking, an inverted yield curve has preceded 8 of the last 8 recessions. So there's the other side of the coin. That is a pretty good indicator that we might have, some kind of a recession coming. It's been a pretty predictive tool, historically speaking. Now, on the fixed income side, even though rates have come down a little bit, this is the range of returns over the past 10 years across different types of fixed income, from Treasury to all this other type of debt. And you can see the average is represented by the purplish bar here. And rates are still, while they're not at their peak, they're still pretty elevated historically. So the risk return opportunity in fixed income appears to be pretty good right now. And if rates do continue to come down, you're going to benefit if you own this from not only the coupons that you're clipping along the way, but you could also have some price appreciation in the bonds. This is a really busy slide, but what it shows you is basically, this is called reflexivity, where an impact of a 1% rise in interest rates doesn't hurt prices as much as a 1% decrease in return in yields improves the price of these bonds. So for example, a 10-year bond, if interest rates were to drop 1%, they would actually go up 20.6%. If interest rates go up 1%, they'd only lose 12.5%. I say only, but it's just relative to show you how lopsided it is in favor of, if rates go down, it's going to really benefit fixed income. So with that, please call us if you have any questions. We're always here to help you out. We also ask, if you enjoy this, if you'll like us, follow us, and subscribe on YouTube and the other social media networks. And again, we will do these quarterly going forward and as market conditions dictate. So with that, thank